Okay, good morning friends. Okay, let's now start with a new area called as capital structure. Just close that one. Capital structure. Now, when it comes to financing decision capital structure, it has multiple sub components. The first part of the chapter focuses on something called as indifference point and break even point. Indifference point is the level of EBIT at which two different financial plans will give same EPS. So a company may be funded entirely through debt. It can be funded through debt and entirely through equity or debt and equity, debt, equity and preference. So we are looking at a combination wherein the level of EBIT at which two different plans will give the same amount of EPS. That is basically called as indifference point. In order to do that, we assume EBIT as X, get the EPS in terms of X and then equate. When we equate, we'll get to know what is the level of EBIT at which two different plans will give the same amount of earnings per share. Then we also have something called as financial break-even point. The term break-even point basically means zero profit, zero loss. Financial break-even point means the level of EBIT at which EPS is zero, earnings per share is zero. Financial break-even point is equal to interest plus preference dividend divided by 1 minus tax rate. Interest plus preference dividend divided by your preference dividend alone is divided by 1 minus tax rate. This is the first segment of the chapter. The second segment of the chapter focuses on capital structure theories. We have something called as net income theory, net operating income theory, Modigliani-Miller theory and traditional theory. So multiple theories are there and each of them has a focus area. Each of it has a different, okay. Others, can you confirm, is the audio getting stuck? I got a message that audio is getting stuck. Others, is the audio clear, not clear? Friends, can you confirm on the audio part? The audio is getting stuck. Okay, now clear. Okay. Clear or not clear? Some of you are saying it is clear. Okay, so then we have different capital structure theories. Each theory has made a conclusion about value of the firm. I'll discuss that when I do a problem, but this is the format we'll follow to calculate the value of firm. EBIT less interest, EBT less tax, EAT if it's with taxation. Without taxation means less tax will not come in our format calculation. Cost of debt, cost of equity, cost of capital, value of debt, value of equity and value of firm. There are certain assumptions which capital structure theories have made. One of the assumptions is there are only two forms of capital. We don't have preference in the different capital structure theories. All earnings are distributed as dividends. So technically there is no concept of retained earnings. Whatever the company is earning, the entire amount will be paid out as dividend, which also indirectly means there is not going to be any growth in any of the companies. We'll see this when I do problem on those theories. Let's first look at your financial break-even point and indifference point. Let's come to question number 1. Let's come to question number 1. Question number 1, page 51. Question 1, page 51. Modern Chemicals Limited required 25 lakhs for a new plant. This plant is expected to give EBIT of 5 lakh. While deciding about the financial plan, the company considers the objective of maximizing earnings per share. 3 alternatives to finance the project: either go with debt of 2 lakh 50 or 10 lakh or 15 lakh, and the balance in each case by issuing at rupees 150. The issue price will decline to 125 in case the funds are borrowed in excess of 10 lakh. Funds can be borrowed at the rate of 10% up to 250, 15% over 250 up to 10 lakh and 20%. Tax rate is 50%. Which form of financing should the company choose? This is basically a problem on optimum mix. That is, this company needs 25 lakh rupees. They have an option of borrowing 2 lakh 50, issuing shares of 22 lakh 50, or borrowing 10 lakh, issuing shares of 15 lakh, or borrowing 15 lakh and issuing shares of 10 lakh. I need 25 lakh rupees. plan is to borrow 2 lakh 50 or 10 lakh or 15 lakh, and the balance is going to be through equity share. Our objective is to maximize earnings per share. The objective is to maximize earnings per share. Whichever option is giving maximum earnings per share, that is the choice I am going to take. Let's start. Working note 1. Identification of alternatives. Identification of alternatives. Alternative 1. Raise debt of rupees 2 lakh 50 and equity of rupees 22 lakh 50. Debt of 2 lakh 50 and equity of 22 lakh 50. Alternative 2 is raise debt of rupees 10 lakh and equity of 15 lakhs. And last alternative, debt of 15 lakhs and equity of 10 lakhs. So we are basically trying to find what are they going to do for the different plans. So these are the plans they have. Either they can go for borrowing of 250, 10 lakh and 15 lakh. Balance obviously will come in the form of equity. For all these three, I want to know what is the EPS, what is the earnings per share of the company. Working note 2, computation of interest, preference dividend and number of equity shares. Interest, preference, dividend, number of equity share. It's not mandatory to do this step. You can directly do the calculation. I follow series of steps. You can even directly do the third step. When I do the third step, you'll understand. Particulars, alternative 1, alternative 2 and alternative 3. See, what is going to be distinguishing these three plans is interest expenditure or preference dividend or number of shares. This question doesn't have preference dividend, but some question can also have preference dividend. From an optimum mix point of view, this is a problem on optimum mix. So what we do is interest, existing, new, total, preference dividend. Most of the question preference dividend may not be there, so you need not even write this. Existing, new and total. Number of shares, number of equity shares, existing, new and total. Now this could be a company which is currently existing. If it's a currently existing company, if at all they give data, they can give some data on current interest expenditure, current equity share or current preference dividend. Existing data will be same for all the three plans, because on top of that you are doing something. So existing, I don't see any information in this question. So there is no existing interest expenditure, there is no existing preference dividend, there is no existing equity share. Question can give you this data. If they give you, it's the same for all the three. Existing data will remain same for all the three: existing equity share, existing interest and existing preference dividend. On top of this, in the first plan, I am borrowing 2 lakh 50. On the first plan, I am borrowing 2 lakh 50. What's the rate of interest for 2 lakh 50,000? 10%. So I have to pay interest of 2 lakh 50 into 10%. 2 lakh 50 into 10%, 25,000 interest I have to pay. 2 lakh 50 into 10%, 25,000 interest I have to pay. In alternative 1, we have to pay interest of 25,000. We have to pay interest of 25,000. In second alternative, I am borrowing 10 lakh. First 2 lakh 50 will be at 10% and that extra borrowing will be at 15%. Somebody can even say, no, the entire 10 lakh I want to take it as 15%. That's possible. I am assuming slab rate. You can assume also flat rate. Slab rate is what happens in income tax. The first 5 lakh has a different tax rate, next 5 lakh has a different tax rate. So you can assume a slab rate kind of a system, or you can say no, the entire 10 lakh will be at 15%. That's your wish. I think ICI in this question did this. So 25,000 plus another 7 lakh 50 into 15%. Another 7 lakh 50 into 15%, that extra amount. Similarly, 137,500 plus another 5 lakh into 20%. Another 5 lakh into 20%. So this would be the interest expenditure for the different plan. The first plan has an expense of only 25,000. Second plan has 137,500. Third plan has 237,500. I have assumed something called as okay. Just give me a minute. Okay, I hope you will not have audio issues now onwards. I've changed the Wi-Fi connection. Okay, so this is the interest expenditure. Balance, I'm going to issue equity share. 22,50,000 divided by 150 issue price. 22,50,000 divided by 150 is the issue price. They have said balance money will be raised by issuing the shares at 150 rupees, but it is expected to decline to 125 in case, not in cash, in case the funds are borrowed in excess of 10 lakh. If you borrow more than 10 lakh, the issue price of share is 125. Otherwise, the issue price is 150. So, in this case, 22,50,000 by 150, 15 lakh by 150, and 10 lakh by 125. My issue price comes down to 125. Once this is done, balance becomes more of a formality to get to the answer. They want us to calculate earnings per share. For all the three plans, we are required to calculate earnings per share. Sorry, I should have copied it here. Preference dividend anyway is not there. This question doesn't have any preference dividend. So, the number of shares are 15,000, 10,000 and 8,000. Any doubts on this? Working note 3, computation of EPS. We have a standard format for calculating EPS. Whichever plan gives us the maximum EPS, that is what we will choose. We start with EBIT less interest EBT less tax, EAT less preference dividend, EAES number of shares, EPS. Most of the question will end here. This question is going to end here. Sometimes after this you can do P multiple. I may do it in some question, okay. MPS, number of shares, market value of equity, market value of debt, market value of preference, and market value of firm. Some question may ask you to complete till the valuation of firm. Some question may tell you to stop at EPS. This question, the objective was to maximize EPS. The objective was to maximize earnings per share. Now, this is a very simple thing. I'll quickly do it. The EBIT given in the question is 5 lakhs. The EBIT given in the question is 5 lakhs. The interest will keep changing for different alternative. So, 25,000, 137,500 and 237,500. The interest will keep changing. 25,000, 137,500 and 237,500. EBT 475, 362,500 and 262,500. Tax is at 50%. tax is at 50%, EAT. I'm not really bothered about explaining this part of it. What was critical was the earlier part. Preference dividend is 0. EAES is this amount itself. Number of shares you had calculated earlier, 15,000, 10,000 and 8,000, and my objective is to maximize earnings per share. So I have maximum EPS in alternative 2. My maximum amount of earnings per share is in alternative 2. So I'll go ahead with alternative 2. If the objective is to maximize earnings per share, we will go ahead with alternative 2 because that maximizes the earnings per share of the company. Any doubts on this? Clear? Let's come to this. Calculate the level of earnings before interest and tax at which the EPS indifference point between the following alternatives will occur. So the question is on indifference point. The steps are broadly going to remain same. Equity share capital of 6 lakh, 12% debenture of 4 lakh. Equity share capital of 4 lakh, 14% preference share capital of 2 lakh, 12% debenture. Tax rate is 35%. Par value of equity share is 10 in each case. The par value, the face value is 10 rupees. Clear? Nothing much for you to see in the question. I'll follow these steps again. The initial, I think some 7-8 questions will follow the same pattern. My alternative 1 and 2 are given in the question. I'm going to technically copy paste those alternatives. The alternative 1 is equity of 6 lakh and debenture of 4 lakh. Equity of 6 lakh and debenture of 4 lakh. Alternative 2 is equity of 6 lakh, preference of, okay, sorry, equity of 4 lakh, preference of 2 lakh and debenture of 4 lakh. Now, some of you may feel that this is unnecessarily repeating thing. You can directly even do the working note 3. That's up to you. I'll calculate this. There is no existing data in this question. I have only 2 alternatives, no existing data. There's no existing information in this question. The interest for alternative 1 is 12% debenture of 4 lakh, 48,000 rupees is the interest. 48,000 is interest. And this side it is 12% debenture, again 48,000. 4 lakh rupees. Debenture is 4 lakh rupees in both. No existing preference dividend. Alternative 1 does not have preference capital. Alternative 2, the preference dividend is 28,000. 14% into 2 lakh. 14% into 2 lakh. No existing equity share. Alternative 1, the equity share is 60,000. This is 40,000. 60,000 and 40,000. Now, I am going to take this as X. EBIT will be taken as X. In order to calculate indifference point, you will assume EBIT as X. You will assume EBIT as X. So this will become X minus 48,000. X minus 48,000. Assume EBIT as X. You could have directly started here itself. You could have directly started at this stage itself. EBIT X, interest you subtract, because that step which I do is just to ensure that you don't make any mistake. In case you want to do it directly also, you can do. Taxes, I think 35%. So 0.35 X minus 48. I'm not going to simplify the equation. 0.35 into X minus 48. This is 0.65 into X minus 48. 0.65 into X minus 48. No preference dividend, alternative 1. This has a preference dividend of 28,000. Can you tell me 0.65 into 48,000 is how much? Into 48,000. 31,200. This side 0.65x, 31,200, another 28,200, 59,200. And the EPS is alternative 1. The alternative 1 EPS is 0.65x minus 31,200 by 60,000. This is the first alternative EPS, 0.65x minus 31,200 divided by 60,000. Second alternative is 0.65x 59,200 by 40,000. You need to solve this and get an answer to x. That's the indifference point. Once you solve this, you will get an answer to x. That is basically the indifference point. Indifference point is the level of EBIT at which EPS is same. So we are equating both. We are equating both. This side 3, this side 2. 1.3x minus 62,400. 1.95x minus 177,600. Solve x and let me know. 1.3x minus 62,400. 1.95x minus 177,600. Solve this. Same thing which we did in the previous question, just that I have taken EBIT as x. I have taken EBIT as x. Solve and let me know. Is it 177 to? Yeah, 177 231 is the number I get. Let me know if at all any calculation error are there. Otherwise, the answer should be this: 1,77,231. 1,77,231. Clear? Any doubts on this? Any doubts on this part? I'll move to question 3. I'll move to question 3. So for indifference point, you have to assume EBIT as x and keep proceeding. Let's come to this. A company needs 31,25,000 for the construction of new plant. Following 3 plants are feasible. 3,12,500 shares of 10 each. 1,56,250 shares of 10 each and 15,625 debenture of 100 denomination, 8% rate of interest. That should have been interest. 156,250 of 10 per share, 15,625 preference share, bearing a 8% rate of dividend. EBIT is so much. What are the earnings before tax? Which alternative would you recommend? Financial break-even point. EBIT, EPS, indifference point by formulae between plan 1 and 2, 1 and 3 and 2 and 3. Okay, again, it's pretty much the same thing. It's so many things have been given, but it's pretty much the same thing which I've done, except for one additional point called as financial break-even point. Indifference point can only be between 2 alternatives. For example, if they give 1, 2, 3 plants, then you have to get one indifference point between 1 and 2, then 1 and 3, 2 and 3. If they give 4 plants, then between 1 and 2, 1 and 3, 1 and 4, 2 and 3, 2 and 4, 3 and 4. So many indifference points may have to be calculated. Sometimes when you try calculating, you will not get an answer. That would mean there is some domination. You will understand what is domination as we proceed. Now, they have given so many levels of EBIT. They say EBIT is 62,500, 125, 250, 375, 625. I cannot keep preparing so many statements because I have to start with 62,500, get the EPS. Start with 125, get the EPS. Start with 250, get the EPS. The first question we did. Start with 375, get the EPS. Start with 625, get the EPS. So many calculation may take you, from an exam point of view, it could be slightly difficult. For me in Excel, I just change the EBIT number, the EPS will automatically come. But in your case, it could be difficult. So we'll answer 1 and 2 in some time. We'll answer 1 and 2 in some time. I'll directly go to the third part, that is calculation of your financial break-even point and your indifference point. So I'm bringing alternative 3 here. I'm not following those initial steps, okay? The initial step is you will have to first write the alternatives. After writing the alternatives, you will have to calculate interest, preference, dividend separately. I'll directly do the calculation here. Okay, I've assumed x as EBIT. First alternative, I don't see any interest expenditure being there because it has entirely equity financed. Entirely equity financed, so 0. Interest is 0. EBT is x. Tax is 40%. 0.6x. 0. 0.6x. 312,500. And EPS is 0.6x by 312,500, 0.6x by 312,500. I started with EBIT as x. There is no interest expenditure. There is no preference dividend in alternative 1. We used to write it as a separate step and come here. When it comes to alternative 2, can you calculate the interest expenditure? How much? 1 lakh? 125. X minus 125. 0.4 into x minus 125. I'm not going to simplify this as of now. 0.6 into x minus 125 no preference dividend. So 0.6x minus 75,000, we have simplified, and this has I think 156 250 share. This has 156 250 share, and this number is 0.6x minus 75,000 divided by 156 250 divided by 156 250. This is the EPS of your alternative 2. You started EBIT as x and kept on working out. It turned out to be 0.6x minus 75,000 whole divided by 156 250. This alternative I don't have interest, so till this it will remain like this. Then there is a preference dividend of 1,25,000. So 0.6x minus 1,25,000. Number of shares is this. Okay, so we have got the EPS for all the three in terms of x. Okay, the first level EPS is 0.6x by 312,500. The second level EPS is 0.6x minus 75,000 whole divided by 156 250. The third one EPS is 0.6x minus 1,25,000 whole divided by 156 250. So we have computed this in terms of x. Any doubts till this? Okay, now after the EPS is calculated, I will do something called as financial break-even point. Financial break-even point. The formula for financial break-even point is interest plus preference dividend alone divided by 1 minus tax rate, because the objective is what is the level of EBIT at which EPS will be 0. So I want to recover my interest expenditure. I also want to pay preference dividend. Preference dividend unfortunately is paid out of profit after tax. So whatever you are earning, you have to pay tax on that and then pay preference dividend. On interest, you can directly pay out of EBIT. Tax may not be there, because if your interest is equal to EBIT, you will have 0 taxation. But unfortunately for preference dividend, we have to do divide by 1 minus tax rate. This is 0. There is no interest, there is no preference dividend. This is 125, the entire interest expenditure, and this is 125 by 0.6. 125 by 0.6. The first plan, no interest, no preference dividend. Financial break-even point is 0. Second one is 1,25,000 of interest. Third one is 1,25,000 of preference dividend divided by 0.6. Divided by 0.6. So we have got this. Now we are required to calculate indifference point. I am required to calculate between plan 1 and 2, 2 and 3, 1 and 3. I am just going to do 1 and 2 and 2 and 3. I am not doing 1 and 3. 1 and 3 is of no use. Basically, you will not learn anything there. 1 and 2, if I do, between 1 and 2, you will have to equate 0.6x by 312,500 divided by 0.6x minus 75,000 by 156 250. 1 times 2 times, this goes this side, 1.2x minus 1,50,000, 1,50,000, 2,50,000 will be the EBIT. 2,50,000 will be the EBIT, at which plan 1 and 2 will give the same result. 1 and 2 will give the same result. 1 and 2 is going to give the same result at 2,50,000 of EBIT. Any doubts on this? If I do 2 and 3, 2 is 0.6x minus 75,000 by 156 250, 0.6x minus 1,25,000 by 156 250. This and this got cancelled. This and this got cancelled. Now I am left with something. I cannot have minus 75,000 is equal to minus 125. So something seemed to be wrong. If you try to solve and you don't get an answer, it means one plan is dominating the other plan. It means either 2 is always better than 3 or 3 is always better than 2. What is indifference point is, before indifference point one plan will be good. After indifference point the other plan will be good. That is what indifference point is. If you don't get an answer to indifference point, either 2 is always better than 3 or 3 is always better than 2. Now which is always better is a plan between 2 and 3, whichever has lower financial break even point. Between 2 and 3, whichever has lower financial break even point is going to dominate the other plan. Between 2 and 3, don't look at 1 now. Between 2 and 3, 2 has a financial break even point of 1,25,000. 3 has a financial break even point of 2,08,333. It means plan 2 always dominates plan 3. Plan 2 always dominates plan 3. In short, there are only two plans, plan 1 and 2. 2 and 3 is of no use. That 3 is of no use. So I did not try doing 1 and 3 in exam. You may have to do it if the question asks. But 3 is of no use. 3 is of no use. You can get an answer, but 3 will never come in my analysis. 3 is not going to come in my analysis because 2 is always better than 3. Now, question had also asked, calculate your EPS for all of this. Now, I cannot prepare a statement. So, what we did is, we say EPS is 0.6x by 312,500. In place of x, you can substitute 62,500, you will get one answer. Substitute 1,25,000, you will get the second answer. Substitute 2,50,000, you will get the third answer. Substitute 3,75,000, substitute 6,25,000. That substitution would have been done here. This is the EPS. I substitute here, and this is the earnings per share. I substitute and I get the earnings per share. You will see 2 is always better than 3. You can just check. 2 will always be better than 3, whatever is the level of EBIT. Whatever is the level of EBIT, plan 2 will always be better than plan 3. At 2,50,000, 1 and 2 will be same. At 2,50,000, 1 and 2 will be same. Below 2,50,000, a plan between 1 and 2, below 2,50,000, a plan with lower financial BEP will be better. Between 1 and 2, below indifference point, a plan with lower financial break even point is better, and above indifference point, a plan with higher financial BEP is better. Between 1 and 2, 3 is anyway eliminated. This is the final selection. Less than 2,50,000, plan 1 is better. At 2,50,000, plan 1 or plan 2, you are indifferent. About 2,50,000, plan 2 is better. You can understand that in this table also, or you can say this has lower financial BEP and this has higher financial BEP. Lower financial BEP will be better for below indifference point. Higher financial BEP will be better for above indifference point. Simple rule, take EBIT as X. Start calculating EPS in terms of X. If they give so many EBIT level, you keep substituting. And do the calculation. If they have not given so many levels of EBIT, then you can directly do it, which is what we did in the first question. When you are trying to solve an indifference point, if you are not getting an answer, it means one plan is dominating the other plan. The rule is a plan with lower financial break even point will dominate the plan with higher financial break even point. Any doubts on this? Let's come to question 4. X Limited is considering the following two alternative financing plan: equity share, 12% debenture, preference share. Indifference point is 2,40,000, corporate tax rate is 30%. Calculate the rate of dividend on preference share. So they have given the indifference point. They want us to calculate what is the rate of dividend on preference share. This will become like a balancing figure. It will become like a balancing figure. I follow the format which we normally do. I am not doing that part of your writing the alternatives and then calculation of interest, preference, dividend for want of time. I normally expect students to do that, because when you do that, you will ensure that mistakes are not done. But it's up to you if you want to do it in exam or not. But I would obviously prefer you to follow those steps of writing the alternative, calculation of interest, preference, dividend, and your number of equity share, and then you follow this. The indifference point is given in the question, which is 2,40,000. Indifference point is the level of EBIT. 2,40,000. 2,40,000 is the indifference point. Interest in the first alternative is 24,000. Second alternative, I do not have interest expenditure. Tax rate is 30%. EAT. I don't have preference in the first option. Second option, I have preference. We'll see what is to be done. Number of shares in the first option is 40,000. So my earnings per share is 3.78. Earnings per share is 3.78. In the alternative 2, I don't know the preference dividend. In the alternative 2, I don't know the preference dividend. But the rule is at indifference point, both plan will give same EPS. So I copy this 3.78. The number of shares for the second alternative is also 40,000, which means EAES is 151,200 reverse working, and preference dividend balancing figure is 16,800. The preference dividend balancing figure is 16,800. They wanted the rate of preference dividend. Rate of dividend is 16,800 by 2 lakh. 16,800 by 2 lakh. They wanted the rate of dividend, which is 8.4%. The rate of preference dividend is 8.4%. The rate was not given in the question. Let's come to this. Akash Limited provides you the following information: EBIT, interest, EBT, income tax, EAT, number of equity share, EPS, P multiple. This question has P multiple also. Company has reserves and surplus of 7 lakh and require 4 lakh further for modernization. Return on capital employed is constant. Debt plus debt, in bracket they have said debt ratio, debt divided by debt plus equity higher than 40% will bring the P ratio down to 8 and increase the interest rate on additional debt up to 12%. You are required to calculate what is the probable price if you raise amount as debt, if you raise amount as equity at the ruling market price. First go through the question. Okay, now there are certain things which you need to understand. This is an existing company, okay, it is an existing company. For an existing company there could be an existing interest expenditure, on top of that extra expenditure can be there. There can be an existing number of equity share, on top of that extra shares can be there. So it will make a lot of sense for us to do that step which we normally do. I am anyway going to directly explain it, but existing will remain same for both. On top of that, if you are raising, they have said they have two options. You can raise it as debt or you can raise it as equity shares. You can raise it as debt or you can raise it as equity share. Also they are bringing in one complication. They are saying debt divided by debt plus equity. This is called as debt ratio, which we did as part of our calculation, as part of our analysis in ratio analysis. Higher than 40% will bring the P multiple down and increase the rate on additional debt to 12%. So this new borrowing I am getting, I don't know what is the borrowing rate for that. The existing borrowing is at 10%. The new borrowing can continue at 10%, can also be 12%, provided I want to check this debt ratio. So first let's check this debt ratio. Working note 1, computation of debt ratio. Computation of debt ratio, particulars, alternative 1, alternative 2, debt, equity, reserves, debt ratio. Debt, equity, reserves and debt ratio. As of now, the company has debt of 40,000 divided by 10%. You look at the interest of the company is 40,000. So the existing debt is 40,000 by 10%. On top of that, another 4 lakh will be taken. On top of that, another 4 lakh will be taken. 40,000 by 10%. On top of that, another 4 lakh is going to be taken by the company. They have planned to raise 4 lakh in the form of debt. If the additional amount is raised as debt, this side it will continue to be 4 lakh. When it comes to equity, I have 30,000 shares. I have 30,000 shares. In my books of accounts, they will be valued at 10 rupees per each. In my books, it will be only 10 rupees. So 30,000 into 10 and I plan to raise another 4 lakh. I plan to raise another 4 lakh. So 3 lakhs and 7 lakh. Reserves and surplus as of now is 7 lakh rupee. Reserves and surplus as of now is 7 lakh rupees. So debt divided by debt plus equity. Debt divided by debt plus equity. The ratio is going above 40%. The ratio is going above 40%. If it goes above 40%, the new debt will be taken at the rate of 12%. The new borrowing will be taken at the rate of 12%. The question has said, in case the debt ratio is higher than 40%, it will bring the P multiple down to 8 and increase the interest rate on additional debt to 12%. So the new loans will be taken at a rate of 12%. The P multiple for that is 8 times. What is the use of P multiple? You will understand. As of now, the P multiple is 10. So I can also write one more thing. Applicable P multiple. Here the P multiple will be 8 times. Here the P multiple will be 10 times. The P multiple will be 8 times and 10 times. The P multiple will help you in calculating the price later. This is one part of it. The second important part is something like this. They have mentioned ROC is constant. Return on capital employed is constant. This is a very important word there. As of now, company is earning 2,80,000. Okay. This 2,80,000 is earned with borrowing of 4 lakh, equity of 3 lakh, reserves of 7 lakh. Company is earning 2,80,000 with 4 lakh of borrowing, 3 lakh of reserves and 3 lakh of equity and 7 lakh of reserves. What is this percentage coming out to be? 20%. ROC is constant. If they use this word, means when you do that calculation, you're going to calculate EPS in the next working note. When you do EPS, the first line item is EBIT. The first line item is EBIT. I cannot copy 2,80,000 as EBIT. I cannot copy 2,80,000 as EBIT. The reason for that is, today you are earning 2,80,000 with 14 lakhs. 2,80,000 with 14. This 14 will go up to 18 either with debt or with equity. Either you borrow money or you issue equity share. Overall, the capital will from 14 lakhs will go up to 18 lakhs. The capital is going to increase from 14 lakhs to 18 lakh, which indirectly mean you will earn 18 lakh into 20%. You will earn 18 lakh into 20% and EBIT will be now 3,60,000. EBIT will be 3,60,000. Some question in fact will say ROC will further improve, ROC will deteriorate. They can mention anything. So it will now become 3,60,000 of EBIT. Beyond this, I don't have much to do.
So can we say when you raise further capital, EBIT will increase?
It has to go up because you are bringing in more money. When you bring in more money, you have to pay now money to your shareholders or to your debenture holders. Some extra income has to be there. If there is no extra income, then there's no point in raising money, no? Because when I raise money, I have to pay interest, or I have to pay preference dividend, or I have to pay equity dividend. Why should I raise money when your EBIT cannot go up? So I follow this now. EBIT is going to be 3,60,000. Beyond this, there's nothing much to be explained. EBIT is 3,60,000. Interest is, I've copied 40,000 for both as of now, just 40,000, which is your existing interest. On top of this, another 48,000. On top of this, another 48,000, because the new loan which you are going to take, you will take it at 12% rate of interest. Alternative 1, you are borrowing money. Alternative 2, you are raising it in the form of equity share. EBT. What's the tax rate given in the question? 50%. Tax rate is 50%. You get EAT. No preference dividend. EAES. My number of shares, existing shares are 30,000. I need to raise 4 lakh money. At what price they will issue? They have mentioned something in the question. They are going to issue this 4 lakh at what price? What is the current market price?
So EPS into P multiple.
EPS into P multiple, the current market price is 40. The current market price is 40. So 4 lakh divided by 40 will lead to how many extra shares? I think 10,000 extra share. 10,000 extra shares. So this is 40,000. I get my EPS. P multiple is 8 times here, 10 times here, and this is the market price. Some 36 rupees and 40 rupees. The market price is going to be 36 and 40. 36.27 and 40 rupees. That's going to be the market price for the two scenario. They just asked for the market price. Yeah, they've just asked us to calculate the market price. They've not told us to do anything beyond that. 36.27 and 40 rupees. Any doubts on this? One important factor is calculation of EBIT. I have explained this in detail here. 2 lakh 80, 14 lakh, 20%. Same 20% continues, but the capital employed will now become 18 lakh. So your EBIT will go up to 3 lakh 60. Any doubts on this? Go through question 6.
So for the new EBIT, both the alternatives will have the new EBIT.
Yeah, whatever is the new EBIT you're getting. Go through question 6. Okay, a company earns a profit of 3 lakh after meeting its interest liability of 1 lakh 20. This profit can be assumed as PBT or PAT. They have used the word after meeting its interest liability. So I would mean that from EBIT interest could have been subtracted, and this is EBT. This indirectly mean EBIT is 4 lakh 20. When you look at the number, you will have to think about all this. EBIT is 4 lakh 20. It also mean my debenture value is 1 lakh 20 by 12%, 10 lakh rupee. The debenture value is 10 lakh rupees. The tax rate is 50%. Number of shares are 10. 10 into 80,000. Retained earnings is 12 lakh. Company plans to take up an expansion for which a sum of money of 4 lakh is required. It is anticipated that after expansion, the company will be able to achieve the same return on investment as at present. I want you to do only two things. Can you tell me what is the existing ROCE or ROI? Both are interchangeably used words. And what will be the new EBIT after expansion? What is the existing ROCE and what is going to be the new EBIT post expansion? We are now going to calculate EPS and all. No, Tarni, it's not 21%. Check it again. What is the existing ROCE of the company or ROI, whatever name you want to use? And what will be the new EBIT post expansion? What will be the EBIT post expansion? Similar to the previous question, but I am not getting into that EPS calculation, all that I am not doing it. You do calculation on ROI and new EBIT. Correct. Get the new EBIT. Get the ROI and the new EBIT. ROI and the new EBIT. What is the new EBIT? Tell me that. Yeah, 14 is right, Kavya. Tell me the new EBIT post expansion. Balance is a formality. I don't want to really spend time on that. How much? No, 56 is not right. 4, yeah, it should be 4 lakh 76. The new EBIT will be 4 lakh 76. Listen, the existing is 4 lakh 20. The existing is 10 lakh of debenture, 8 lakh of equity share, 12 lakh of retained earnings. Put together the capital is 30 lakh. Put together the capital is 30 lakh, which indirectly mean the return is 14%. The return is 14%. 10 lakh of debentures, 8 lakh of equity share and 12 lakh of retained earnings, all put together 30 lakh is the capital employed. My ROI is 14%. This 30 lakh will now become 34. It will become 34. Either you raise extra debt or you raise equity share, but 30 lakh will become 34 lakh. 30 lakhs will become 34 and my EBIT will be 34 lakh into 14%. 34 lakh into 14%, which is I think 4 lakh 76,000. Clear? Any doubts on this? Let's look at quickly question 7. Following figures of Theta Limited are presented as under: EBIT, debenture interest, long-term loan interest. See, when they give that rate, the reason for giving the rate is you can reverse work the amount. You can reverse work the amount at 8%, at 11%, income tax, earnings, EPS, market price, P multiple. The company has reserves and surplus of 20 lakh. It is in the need of 30 lakhs to pay off the debentures and modernize its plant. It seeks your advice on the following alternative: raise entire amount as term loan from banks at 12%, raising part of the funds by issuing 1 lakh shares of 20 and rest of them at loan at 12%. Company expects to improve its rate of return by 2% as a result of modernization, but P multiple will likely to go down to 8 if the entire. Advise the company on the financial plan to be selected. It's assumed that there will be no change in P multiple in either of the two alternatives adopted. Would your advice still hold good? Now, I want you to calculate 2-3 things again. Go through the question in detail. First, tell me what is existing ROI, okay? The new ROI is not going to be same. Something is mentioned in the question, okay? The new ROI will be different. After the new ROI, what is the new EBIT? What is the new EBIT? Read the question carefully. Existing EBIT is 23 lakh. Existing EBIT is 23 lakh. Tell me what is the existing return on investment percentage? What is the return on investment percentage? Existing return on investment percentage. Capital employed will include debenture, term loan, equity shares, retained earnings. How much? 23%. Okay. Should be right. 80,000 by 8%, 10 lakh. 2 lakh 20 by 11%, 10 lakh. 5 lakh shares of 10 each, 50 lakhs. And sorry, 2 lakh 20 by 11% is 20. And reserves of 20 lakh. So all put together, the capital is now 1 crore. The existing capital is 1 crore. So the existing ROI is 23%. The existing ROI is 23%. The question says this ROI will improve by how much? 2%. The ROI will improve by 2%. The company expects to improve its rate of return by 2%. So 23 will now become 25. Read carefully and tell me 1 crore capital will become how much now? Read carefully. Read carefully. Read carefully and tell me 1 crore capital will become how much? Go through it carefully. How much money are we raising? 30 so should 1 crore become 1 crore 30? Normally it should become 130 lakhs, but it's not going to be 130. There's something there. Can you read what is the purpose of raising money? To pay off? So unfortunately this 10 lakh will not be there in future. This 10 lakh will not be there in future. So 30 lakh will get added. I agree to that, but 10 lakh will get removed. 30 lakh will get added, but 10 lakhs will get removed in the capital employed of the company, because one of the purpose is to pay off debenture. One of the purpose is to pay off debenture. That is what the question has mentioned. So because of that, 1 crore will become 90, 90 will go up by 30 and will become 120, and your new EBIT is 30 lakh rupees. Beyond that, I don't have much in this question. 25% into 120 lakh. 25% into 120 lakh. The question has clearly mentioned that I am planning to pay off the debentures. That is where I think detailed comparison would have been presented here. Equity capital continues, reserves continue, debentures do not continue. Debentures do not continue. So term loan is their preference and new capital is introduced of 30 lakh. So all put together, now the capital has become 1 crore 20, not 1 crore 30. From 1 crore, the capital has become 1 crore 20 only. It has not become 1 crore 30. In a normal scenario, I agree it will become 1 crore 30, but understand the objective. Sometimes the question may say the company is planning to raise 10 lakh to repay the debenture. Capital will not change itself. The capital is not going to change itself. Also, you need to take care of one aspect when you prepare your statement. This interest of 80,000 will not continue. That is where I normally prefer doing the statement. If you do step by step, you will not make those mistakes. In existing interest itself, that 80,000 would have to be eliminated. That 80,000 would have to be eliminated. Your wish whether you want to write this or directly do, that's up to you. But what was critical is getting this 30 lakh, which I have explained. Beyond this, it's more of a calculator's job. It's more of a calculator's job. So I am not spending time on that. I'm not spending time on that. The question wanted us to select, advise the company on the financial plan to be selected. One question said maximization of EPS. Okay. Another question wanted you to calculate the market price. This question said what plan is to be selected. When that is asked, wherever P multiple is there, you have to go till market value of firm. You have to go till, see, EPS into P multiple will give you MPS. MPS is market price per share. Number of share will give you market value of share. With that, you have to add debt, preference, and get market value of firm in the end. Market value of firm. Whichever has better market value of firm, that one I'll select. The market value of firm includes even your debt and preference. So calculate. Sometimes they may say stop it at market price. Please stop it at market price. The question may say maximization of MPS can also be an objective. If P multiple is available in the question, you can calculate market price. You can calculate market value of firm if the question wants you to do. This question wanted us to do that because the problem did not say maximize MPS. So we calculated market value of firm. Question 8, you can manage it. It's on indifference point. Same with 9 as well. 8 and 9 can be managed at your end. Okay, let's come to 10. Let's come to 10. It's on indifference point. The only small point I just need to discuss. A new project is under consideration in ZIP Limited, which requires a capital investment of 4.5 crores. Interest on term loan is 12%. Corporate tax rate is 50%. Debt equity ratio is 2:1. Calculate the indifference point for the project. When you read the question fully, just read it once. Okay, for doing indifference point, I need always two alternatives. One there said is 2:1 debt equity ratio. What is 2:1 debt equity ratio is? Of this 4.5 crores, 3 crores will come in the form of debt, 1.5 crores will come in the form of equity. That's one alternative. That's not two alternative. What is the second hidden alternative which is not given in the question? The hidden alternative is going with 100% equity. Going with 100% equity, because if you are not ready to go with a bank borrowing, you have to put your own money, full own money. Beyond that, I don't have much to do. I'll assume EBIT as X, keep subtracting interest and divide by the equity share, get the EPS in terms of X, equate, get to the answer. That's not the difficult part. The only thing is the question has not given the second alternative. The question has not given the second alternative. So if they are not mentioning the alternative is raising entire amount as equity. Raising your entire amount as equity. You will assume X, you will equate, get to the answer. That's a simple part of it. I don't want to spend time on that. Clear? Any doubts on this? So the bank is ready to give you a 3 crore loan. If you are not ready to take that, you will have to bring your entire money. Entire money has to be brought at your end. Okay, this was one part of it. Okay, this was one part of it, which is on your indifference point, your financial break-even point, or your optimum mix. The second segment of the chapter focuses on an area called as capital structure theories. Capital structure theories. We have a format to do that. Let me just spend a little bit of time on the format. I start with EBIT, subtract interest, get EBT, then cost of debt, cost of equity, cost of firm, cost of capital, value of debt, value of equity, value of firm. This is a format we are going to follow. There are multiple theories which are there. Different theory has different conclusion. I'll explain the conclusion when I do a problem. This is one format. Another format can have less tax EAT. There are two capital structure theories. One, without taxes were there. So the theories when come, the taxes were not there at that point of time. So most of the theories assume no taxation, but taxes came into picture. So Modigliani Miller had also revised its theory and they brought in with taxes. Now we have a formula called as cost of debt is equal to interest by value of debt. You can interchange this formula and say value of debt is equal to interest by cost of debt. You can also say interest is equal to cost of debt into value of debt. You can keep interchanging the formula. Cost of debt, interest, value of debt is interlinked. Cost of equity, EBT and value of equity is interlinked. Cost of equity, EBT and value of equity is interlinked. Sometimes you may say value of equity is equal to EBT by cost of equity. Sometimes you will say EBT is equal to cost of equity into value of equity. And cost of capital, EBIT and value of firm is interlinked. Cost of capital, EBIT and value of firm is interlinked. Sometimes I will say value of firm is equal to EBIT by cost of capital. Sometimes I will say EBIT is equal to cost of capital into value of firm. You can keep interchanging. If the question has taxation data, then everywhere into 1 minus tax. EBT into 1 minus tax is EAT. EBT into 1 minus tax is EAT. If at all question has information on taxation. So we will have two types of problem. One with taxation, second is without taxation. Cost of capital, value of firm, EBIT is interlinked. Cost of debt, interest, value of debt is interlinked. Cost of equity, EBT and value of equity is interlinked. Now depending on the theory, depending on the capital structure theory, there could be some adjustments here and there to be made. So I'll explain based on the theory what needs to be done as we proceed. Let's come to this question. Zordon Limited has net operating income of 5 lakh and total capitalization of 50 lakh during the current year. The company is contemplating to introduce debt financing in capital structure and has various options for the same. The following information is available at different levels of debt: debt value, interest, equity, capitalization rate. Assume no tax. Firm always maintains books at book value. You are required to calculate amount of debt to be employed by firm as per traditional approach. Amount of debt to be employed by firm as per traditional approach. Equity capitalization rate if MM approach is followed. I will come to the equity capitalization rate, which is MM approach in some time. This question does not have any taxes in it. There is no tax data in this question. First we are going to do traditional approach. Okay, so I have this format. Along with this, I'll keep adding the multiple alternatives which the question may give. The question can give multiple alternatives, so we'll keep adding them. The question has given 0 debt, 5 lakh debt, 10 lakh debt, 15 lakh debt, 20 lakh debt, 25 lakh debt, 30 lakh debt. Every question I'm going to follow the same format to get to the answer. I don't have anything beyond this to be done. 0 debt, 5 lakh, 10 lakh, 15 lakh, 20 lakh and 25 lakh and 30 lakh. That's given in the question. The interest rates are also given in the question. 0, 6%, 6.2%, 7.5, 8. These are given in the question. Cost of equity is also given in the question. 10, 10.5, 11, 11.3. I'll explain the conclusion of theory as we proceed. 13.5, 16. These are given in the question. It initially said net operating income is 5 lakh. Net operating income is EBIT. Net operating income is 5 lakh.
So, operating income only EBIT. Net.
No, both are same. Net income is PAT. The term operating income, whether you use word net operating income or operating income, both are EBIT. 5 lakh is given in the question. Total capitalization is 50 lakh, means value of the firm is 50 lakh. This is the initial information, okay? This is the initial information. I'll keep doing this scenario now. There is no interest. There is no interest in this scenario. My EBT is going to be 5 lakhs. EBT is going to be 5 lakhs. Value of debt is interest by cost of debt. So in this scenario, there is no debt. In this scenario, there is no debt. Other scenario, I think they had given the debt. 5 lakhs, 10 lakhs, 15, 20, 25, 30 lakhs is the amount of debt. Just give me a minute. Okay. Now, this is the data given in the question. They have given cost of debt, cost of equity, cost of capital. They have given the amount of debt. After I copy this data in this format, any rework scenario, the EBIT will remain same unless they give a new number. The EBIT will remain same unless they give any extra data. If they have given some extra information, I can consider it. Otherwise, the EBIT is going to remain same. Interest, what is the formula I said? What is the formula I can use here? Value of debt into cost of debt. Value of debt into cost of debt into 6%, 6.2, 7%, 7.5 and 8%. I get EBT. So you keep calculating EBT for different alternative. I just need to fill this format, okay? Cost of debt is there, cost of equity is there. Cost of capital, what is the formula? Cost of capital formula. EBIT by value of firm. I'll park it for the time being. I have EBIT, but I don't have value of firm. I don't have value of firm. What is the formula for cost of equity?
EBT by value of equity.
Sorry, value of equity. What is the formula for value of equity? EBT by cost of equity. EBT by cost of equity. EBT by cost of equity. And now I get value of firm. I get value of firm. We copied the value of firm. And I can now get the cost of capital, which is EBIT by value of firm. EBIT by value of firm. Now, I will select an alternative which has the maximum value. I'll select an alternative which has the maximum value. Whichever has the maximum value. So, the alternative which I am going to select is this. The alternative which I am going to select is this. This is as far as the traditional approach is concerned. What we have followed now is the traditional approach. Same question I am going to repeat it under Modigliani-Miller. There is a second part where they have mentioned. Follow it under Modigliani-Miller approach. This question, we had the cost of equity, we had the cost of debt, we copied it. Now, question says, equity capitalization rate if approach is followed. Equity capitalization rate if approach is followed. Now listen. Under Modigliani-Miller, the value of firm for all the 7 alternatives will be same. The value of firm for all the 7 alternatives will be same. What they want you to calculate is equity capitalization rate. The equity capitalization rate is already given in the question. But they are saying what will be the equity capitalization rate if you follow approach. Under approach, I am talking about the conclusion of approach. Approach has said, same question under approach, same 50 lakhs has to be repeated. has said, please follow same 50 lakhs. We want you to follow the same 50 lakhs. The 50 lakhs cannot change. That is the conclusion of the approach. He said value will remain same. He also said cost of capital will remain same. The same 10% will continue. Cost of capital will remain same. So what now we are going to do is, as far as approach is concerned, value of firm has to remain same. Cost of capital has to remain same. We have all of this. EBIT does not change, 5 lakh. Interest was calculated by us. EBIT is calculated by us. Cost of debt is there. Cost of capital is there. Value of debt is there. Value of firm is there. Now reverse working. Value of equity is value of firm minus value of debt. Value of firm minus value of debt. After this is done, can you tell me what is the formula for cost of equity now? Cost of equity formula. EBT by value of equity. You will have to keep interchanging the formula. So this should be the cost of equity for different alternative. 10%, 10.44, 11, 11.63, 12, 12.5 and 13%. Modigliani Miller has basically said that if you borrow more money, cost of equity will go up. Because it goes up, the overall weighted average cost of capital will remain same. The overall weight. This is the answer under Modigliani Miller. You tell me the change in theory, my answer will change. According to Modigliani Miller, the answer is this. According to Modigliani Miller, the cost of equity should have been this and not what is given in the question. Question has given some cost of equity. So what I did is I copied the EBIT, calculated the interest, computed the EBT. The cost of debt was given in the question. Cost of capital will be same 10% always. Cost of capital is going to be same. Value of debt is given in the question. Value of firm will be same 50 lakhs. It is going to be same 50 lakhs. That's not going to change. So we copied the same 50 lakhs, got the value of equity as balancing figure, reverse work the cost of equity. Any doubts in this?
So cost of capital and value of firm is same.
Yeah, always same. Let's come to this. Alpha and Beta Limited are identical except for capital structure. Alpha has 50% debt, 50% equity. Beta has 20% debt, 80% equity. Borrowing rate is 8%. Capital markets are assumed to be perfect. No tax world. So great, there's no taxation in this question. If you own 2% of Alpha, what is your rate of return if the company has net operating income of 360? Overall capitalization rate. Beta has same net operating income. What is its implied rate of return? Why is it lower than that of Alpha? Now, few points you have to see. Whenever you see a problem, first you search whether it is with tax or without tax. Okay, that's one thing. Second, see, is the question talking about any approach? If the question does not talk about any approach, it becomes very simpler. I am least bothered about the approach to be followed. Also, even if an approach is given in the question and there is no rework to be done. See, last question said 0 lakh, 5 lakh, 10 lakh, 15 lakh, 20 lakh. If there is no rework to be done, all 4 approaches, the answer will remain same, because only in rework different theory has different conclusion. Modigliani Miller said value of firm will remain same. Net income theory said value of firm will increase if you borrow more. That is the conclusion of the net income theory. Net operating income and Modigliani Miller gave the same conclusion. NOI Modigliani Miller said the same thing. Your value of firm is not going to change even if you borrow more or you change the capital structure. So different theories are different. This question, one, without taxation. Second, there is no rework to be done. When there is no rework to be done, your answer is going to remain same whichever approach you follow. So we are going to put this data in this format only. Go through the question for the time being. Particulars, and I'll start doing it in a minute. Alpha, beta. Alpha and beta. Okay. Now, without taxation format is there. I'll read. Alpha and beta are identical. Identical will mostly mean same value also. We'll understand, except for capital structure. Alpha has 50% debt, 50% equity. Beta has 20% debt, 80% equity. I can't use this as of now. The combination is 50-50 and 20-80. All percentages are in market. The borrowing rate for both the companies is 8%. Cost of debt is 8. Cost of debt is 8%. If you own 2% of Alpha, let's not bother about. What is your return if a company has net operating income of 3,60,000? Net operating income of 3 lakh 60, and the overall capital. What do you mean by overall capitalization rate? Any idea what is overall capitalization rate? Cost of capital is 18%. Cost of capital is 18%. What is the implied rate of return on equity is the question. Return on equity is, from my point of view, from a company point of view, it's called cost of equity. So what you need to calculate is this. What you need to calculate is this. Can you tell me how do I proceed beyond this? This is the only information I have.
So the cost of capital formula is EBIT by value.
I have EBIT, I have cost of capital, I can calculate what? Value of firm. So value of firm is 3,60,000 by 18%, 20 lakh. Then the question said split this 20 lakh into debt and equity, something they have given for alpha. How much is the mix they said? What is the mix for 50-50? So 10 lakhs, 10 lakhs. Okay. I have cost of debt, I have value of debt, I can calculate what? Interest. Cost of debt and value of debt is there, we can calculate interest, which is 80,000. We get EBT as 2,80,000. You have EBT, you have value of equity, you can calculate cost of equity. What is the cost of equity? 2,80,000 by 10 lakh, 28%. So the implied rate of return on equity of company alpha is 28%. Then we move to beta company. They said beta has the same net operating income as alpha. So same 3,60,000, same 3,60,000. What is its implied rate of return and why is it lower than that of alpha? So they gave same 3,60,000 I have copied, cost of debt I have copied. Nothing else is mentioned in the question. Okay. If nothing else is mentioned in the question, identical companies will have same cost of capital. Identical companies will have same cost of capital. If they had given some cost of capital, I would have used it. Identical company, same company, similar companies will have same cost of capital. With this, what can you calculate? Value of firm. After value of firm, you can split into debt and equity. What is the combination?
20-80.
So 20% is what? Debt. 20% is debt. 80% is equity. With this, what can you calculate now? Interest is 32,000. EBT is 3,28,000 and cost of equity is 20.5. Cost of equity is 20.5. The format will give you the answer, nothing beyond that. The format will give you the answer. Cost of equity is 20.5%. Question wanted us to know why is it lower. The reason for it being lower is beta has less debt. When you have less debt, you carry lesser risk. You carry lesser risk. So when you obviously carry lesser risk, you are going to have lower return. The concept is high risk, high return. So if you are taking more risk, you will get more return. This company has lesser risk, so it will obviously give you lesser returns. So the returns are on the lower side. Let's look at question 13. KLM Limited has an operating profit of 46 lakh. The term operating profit is basically your EBIT. Debt, total interest charge of 10 lakh. Existing cost of equity, cost of debt. It has a proposal of requiring funds of 100 lakh to be raised by additional debt 10%, which will bring in some additional profit. Assume no tax. You are required to find out existing WACC and new WACC. Put it in the same format. You will get the WACC in the same format itself. What is WACC? Is cost of capital. WACC is cost of capital. Put it in this format. There is no tax in this question. No tax in this question. Put the data in this format. Put the data in that table format. I want you to do it. Put the data in that format, you will get to the answer. Please try doing it. Please try to do this. Put the data in that format. We had an EBIT given in the question, which is 46 lakhs. Subtracted the interest, got EBT of 36 lakhs. Cost of debt is 10 and 18. So that gave value of debt of 1 crore, value of equity of 2 crore, and value of firm was 3 crore. Reverse working cost of capital is 15.33. Cost of capital is 15.33%. The question has said additional profit of 19 lakhs. So 46 became 65. Interest went up. EBT is now 45 lakhs. Value of debt from 1 crore is going up to 2 crore. Value of equity remains same 2 crore. So value of firm has gone up to 4. And when I reverse work, I get cost of capital is 16.25. Cost of capital is 16.25. Cost of capital balancing figure is 16.25. Just give me a minute. Any doubts on this? Any doubts on this part? Clear?
Cost of debt also same.
10%, no? The new debt is also 10% only, no? The new borrowing is also 10%. Any doubts on this? Quickly do 14 in the same format. Do 14 in the same format. There's nothing rework to be done. Put 14 in the same format, you will get to the answer. Do question 14 in the same format. Put the data in the same format, please, quickly. EBIT is 1 lakh. Cost of debt is 10%. Value of debt is 5 lakhs. Equity, cost of equity is 15%. Value of firm and cost of capital is EBIT by value of firm, 12%. So the question wanted value of the firm which is 8,33,333 and cost of capital which is 12%. Cost of capital and this both were asked. Cost of capital is 12%, value of firm is 8,33,333. Any doubts on this? Now till now we have done questions on without taxation. Questions on without taxation. Now we are going to bring to questions with taxation. When I do problems with the taxation, if approach is asked in a question, they may give a scenario called as without debt and with debt. You will understand as we do this question. Let's come to question 15. There are two firms P and Q which are identical except P does not use any debt in its capital structure while Q has 8 lakh 9% debenture in its capital structure. Both the firm have same earnings before interest and tax. Capitalization rate is 10%. Corporate tax is 30%. Calculate the value of the firm according to hypothesis. They would have given two companies. One company has borrowing, another company does not have borrowing. So how does that impact in the calculation? You'll understand now. The same format I'm going to add now on less tax EAT, EBIT less interest, EBT less tax, EAT. Now listen for some time. Firm P and firm Q will first complete the solving of a company which does not have any borrowing. Will solve the company which does not have any borrowing. There are two firms P and Q except P does not use any debt in its capital structure. So let's focus on completing firm P and then we'll come to firm Q which has borrowing in its capital structure. It said Q has 8 lakh 9% debenture. Both the firms earn 2 lakh 60. 2 lakh 60. It does not have any borrowing. So your EBT is 260. Tax rate in the question is 30%. EAT is 1 lakh 82. Cost of debt is not applicable. Cost of capital, the capitalization rate. Both the firms have EBIT of 2 lakh 60 and the capitalization rate is 10%, which is cost of capital, or technically it is the cost of equity because it does not have any borrowing. For it, cost of equity or cost of capital both are same. Value of debt is 0. Value of equity is EBT into 1 minus tax rate by cost of equity. EBT into 1 minus tax rate by cost of equity. Can you tell me how much? Or technically it's EAT by cost of equity. EBT into 1 minus tax rate is nothing but EAT. 1,82,000 by 10%. 18 lakh 20. Value of firm is EBIT into 1 minus, I can add also, but the formula is EBIT into 1 minus tax rate by cost of capital. EBIT is 2 lakh 60. 1 minus tax rate is 0.7 and cost of capital is 10%. Cost of capital is 10%. We got the unlevered company. We are done with the unlevered company, the company which does not have any borrowing. Value of levered company is equal to, this is what MMS said, value of levered company is equal to value of unlevered company plus debt into tax rate. Debt into tax rate. Why we are adding debt into tax rate is because when you borrow money there are tax benefits. So he went ahead and said that unlevered company will have lower value. Levered means company which has borrowing, their value will be slightly better. Why is it better? Because they are taking borrowing. When you take borrowing you pay interest. When you pay interest you get tax benefit on interest. So value of levered companies, unlevered 18 lakh 20. How much is the borrowing of the second company? 8 lakhs into 0.3, which is 20 lakh 60,000. They have just asked for valuation. Some question in not only valuation, they may ask for other items also. Like they may ask you for cost of equity, cost of capital. So I'm going to fill this table now. Value of firm of this entity is 20 lakh 60. 20 lakh 60. Value of debt is 8 lakh. Value of equity balancing figure 12 lakh 60. Your EBIT is 2 lakh 60. Interest is 8 lakh into 9%. 8 lakh into 9%. I think the rate of interest was 9% debenture. your EAT is 131,600. EAT is 131,600. Cost of debt is 6.3. Cost of debt is 6.3. Interest into 1 minus tax rate. Interest into 1 minus tax rate, or you can say interest into 1 minus tax rate by value of debt. This interest expenditure of 72,000 into 1 minus tax rate by value of debt. What is the formula for cost of equity? Formula for cost of EBT into 1 minus tax rate by value of equity, or technically EAT by value of equity. So this.
Sir, after finding value of firm, can you just repeat what you did, sir?
Value of firm I got. After getting the value of firm, I have copied the value of debt given in the question. Value of equity is balancing figure. 2060 minus 8 lakh. Value of equity is balancing figure. And then copied the EBIT because both are earning same. Subtracted interest, EBT, subtracted tax, EAT. Cost of equity is EAT divided by value of equity, and cost of capital is EBIT into 1 minus tax rate by value of firm, which is 8.83. 8.83. Some questions may tell you to just do the value of firm. Some question may tell you to ask you to calculate even cost of capital and cost of equity. Any doubts on this? First we will do a company which does not have borrowing, and then value of the company with borrowing is equal to value of the company without borrowing plus amount of debt into tax rate. Put it in the format. The format will give you balance answer. The format will give you the balance answers. Just give me a minute. Okay, do question 16. Part B, okay, not part A. I don't want you to do without taxes. Do second part, 40% taxes. Question 16. Determine the market value, equity capitalization rate, weighted average cost of capital, assuming 40% taxes. Do the format with taxes. Do with taxes format. First complete the value for a company which does not have borrowing. First do the company without borrowing. Same format, you will get to the solution. An extremely simple area, purely format driven. The company which does not have borrowing has a value of 60 lakh. The company which does not have borrowing has a value of 60 lakh. Cost of equity was given in the question, which will give you value of equity and value of firm. Company which does not have borrowing has a value of 60 lakh. Without borrowing, the value is 60 lakh. First, to do the company which does not have borrowing, whose value is 60 lakh. What is the value for the company which has borrowing? 60 lakh plus what is the amount of borrowing? 54 lakhs into tax rate 0.4. 81 lakh 60. In that, debt is 60 lakh. Equity balancing figure. Equity balancing figure 2160. Equity balancing figure 2160. Value of debt is 60 lakh. Equity balancing figure 2160. How much is the debt?
8160 minus 54.
Oh, sorry, 54. Sorry. 2760. Sorry? Can be. Cost of equity is 25.4%. Cost of capital is 13.24. Straightforward format driven area. I don't have anything beyond the format. The format will give you answer to almost all the questions. All questions can be solved using this format. $25.04 and 13.24. So there's one format for with taxes, one format without taxes. With taxes, if it's Modigliani-Miller approach, then you'll have to follow without. First, you will have to value the company for a company which does not have borrowing. Then the valuation is done for a company which has borrowing. Value of levered companies, unlevered plus amount of debt into tax rate. I'm not doing 18, but the 18 talks about something called as net operating income approach. Whenever question uses the word net operating income approach, that net operating income is nothing but Modigliani-Miller. NOI approach is basically Modigliani-Miller. Both the approaches are same. Both made the same conclusion. So if taxes are there, it will work the same way. It will work the same way. Now let me quickly touch upon the. Just give me a minute. 17 is okay, manageable. Just give me a minute. Okay, net income theory, net operating income or Modigliani-Miller. These are the only two types. Traditional theory is there, but that doesn't have a major conclusion. They have made some conclusion on cost of equity, cost of capital. If you are doing any rework scenario under a net income approach, cost of equity will remain constant. Cost of equity, that is whether you have 0 borrowing, 5 lakh borrowing, 10 lakh borrowing, 15 lakh borrowing, 30 lakh borrowing, 50 lakh borrowing, cost of equity will be same. Cost of equity will be same. So if the question says follow net income approach and do a rework, you should copy the cost of equity for all years. You should copy cost of equity for all the scenarios, because the theory said cost of equity will remain constant. Because cost of equity does not change, cost of debt is normally lower than cost of equity. Your borrowing is always cheaper than equity. So cost of capital will come down with borrowing. This is what this theory said, will come down with borrowing, and value of firm will increase with borrowing. Why does value of firm increases? The formula for value of firm is EBIT by cost of capital. If denominator keeps coming down, the value of the firm will keep going up. This set will increase with borrowing. Constant. We did a problem where initial problem they said calculate cost of equity as per Modigliani-Miller approach. So I said value of firm will remain constant, cost of capital will remain constant. Traditional theory, there's another theory where the question has to mention. The traditional theory said cost of debt can rise till some time, cost of debt can come down, cost of equity can remain constant, can go up, can come down, cost of capital can come down, can. So it did not make any major conclusion. It said it all depends on the market expectation. Modigliani-Miller said your cost of capital and value of firm has to remain constant for all rework scenario unless you bring in taxation angle. When you bring in taxation angle, what happens is your value of firm is equal to value of unlevered firm plus amount of debt into tax rate. A same company today could be unlevered. What is unlevered is it does not have any borrowing. After that they may borrow. If you are borrowing, your value will go up. Your value will go up as far as approach with taxes is concerned. Approach with income tax, because what is said is value of levered company is equal to value of unlevered firm plus amount of debt into tax rate. You can quickly note this. Just quickly note this alone.
Value of firm will increase
with borrowing. Okay, clear? Okay, this is the question I was talking about. RES is an all equity finance company with a market value of 25 lakh, cost of equity 21%. Company wants to buy back equity shares worth 5 lakh by issuing and raising 15% perpetual debt. Rate of tax may be taken as 30%. After the capital restructuring, applying model with taxes, you are required to calculate market value, cost of equity and WACC. Before I was an all equity finance company, I am going to do some buyback of share, borrow. So earlier RES is an unlevered company. After that RES will become a levered company. So we were doing comparison of two companies. Now the same company is called as an unlevered company as well as a levered company. So we will do the valuation. Before restructuring, it's an unlevered company. After restructuring, it is a levered company. In the same format, you'll get to the answer. Let's put it in that format. Particulars before restructuring and after restructuring. Before and after. Before restructuring. After restructuring. Their plan are before buyback technically. They are planning to do some buyback and all. Before restructuring and after restructuring. Before and after. Before restructuring and after restructuring. Before restructuring, it's an all equity finance company. Let's capture whatever value they've given. Market value is 25 lakh. Equity will also be 25 lakh because there's no debt. Value of firm is 25, equity is 25. There is no debt in this company. Cost of equity is 21. Cost of capital will also be 21. No cost of debt. Equity and debt will be 21. Okay, before I come to the other part, I have these data. If you have if you have cost of equity and value of equity, you can calculate earnings after tax. You can calculate earnings after tax. The formula was cost of equity is equal to EAT by value of equity, or EBT into 1 minus tax rate by value of equity, which is EAT. So earnings after tax is going to be equal to cost of equity into value of equity. You have to keep interchanging that formula and get to the answer. So this is 25 lakh into 21%, 5 lakh 25,000, 5 lakh 25,000, 5 lakh 25,000, I think tax is some 30%, so divided by 70.3, EBT is 7 lakh 50, there is no interest. EBT is 7 lakh 50 and there is no interest. This is before restructuring. This is before restructuring. After restructuring, it becomes a levered company. It becomes a levered company. The value is unlevered firm plus amount of debt. How much borrowing they are going to take? 5 lakhs. What is the tax rate? 0.3. So value of debt is 5 lakh. Equity balancing figure. Equity balancing figure 2150. Value of debt is 5 lakh. Equity balancing figure 2150. Equity balancing figure 2150. EBIT copy pasted 7 lakh 50. Interest is into 15%. EBT 675. You know the formula for cost of equity. Cost of equity is EAT by value of equity. WACC is EBIT into 1 minus tax rate by value of firm. $21.98 and 19.81. 21.98 and 19.81. Okay, I'll maybe take a break of 15 minutes and then continue with the next area. We'll take a break of 15 minutes and then continue.